Good day, everyone, and welcome to our seminar for October 2023. We begin, as always, in America, where interest rates have remained unchanged for the second time. The Monetary Policy Committee held rates unchanged, but they gave quite a hawkish commentary after the meeting, and that all took place on the 20th of September. And in that commentary, they said that rates could only be expected to begin falling significantly in 2025, and that rates would average about 5.1% in 2024 and then fall to 3.9% in 2025. So the market had to adjust to rates staying higher for longer. And this hawkish comment from the MPC has impacted on the S&P 500. And you see there on the chart on your screen that the S&P has tracked back here now and has reached the lower trend line. And you can see that trend line. This is made now the third touch point in the trend line, starting from October 2022's low. The second touch point over here in March this year, and then now finally a third touch point. It's possible that this underlying trend line may be broken soon, but despite that, in our opinion, the S&P 500 remains in the bull trend which began in March 2009. In time, we see the S&P 500 breaking its cycle high of 4589, which you can see on your screen here at the peak here, and then possibly going on to break the all-time record high, which it made here in January 2022 at 4796. If we look at the US economy, you can see that gross domestic product in the second quarter was up 2.1%, which is pretty robust considering the number of interest rate hikes that they've had in that country. It's evident that the economy is nowhere near a recession, which of course is defined as 2 successive quarters of negative growth. Growth in the second quarter was almost the same as the first quarter's revised growth of 2.2%. And it shows that the rapid rise in interest rates has not really impacted on the economy directly yet. The economy also generated 187,000 new jobs in August of 2023, and unemployment ticked up slightly to 3.8%. Job creation has definitely dropped off as rates have risen, but unemployment has remained pretty much static at between 3.4 and 3.8%. The slight uptick in August may mean that the job market is starting to look a little more bearish. In other words, unemployment is moving up slightly. But the job market remains strong at this stage. And that is, of course, further evidence of the strength of the economy. It seems that the rate hiking cycle is over, though, now, after 2 successive unchanged meetings of the Monetary Policy Committee. And that obviously is a bullish factor in the longer term. In the meantime, while that's been happening, the Republican Party has been having a real meltdown. They almost caused a shutdown, and Kevin McCarthy, who's the Speaker of the House, who was the Speaker of the House until yesterday, managed to get a bipartisan bill through that extended the budget until the 17th of November, so for 45 days, barely avoided a shutdown, but only by getting the support of the Democrat Party. And now, as a result, he's been booted out as Speaker, and the Republican Party has got to look for a new Speaker. So that's going to be a period of further uncertainty. But a shutdown would have put tens of thousands of civil servants on furlough, and obviously they wouldn't be paid then, and also millions of Americans who rely on Social Security would have gone without their checks. The MAGA extremists in the Republican Party are dominating at the moment. They've recently tried to impeach Biden unsuccessfully because they had absolutely no evidence of any wrongdoing. But all this confusion within the Republican Party is not good for them as far as next year's election is concerned. Donald Trump is now facing 4 criminal indictments in 4 different states, and he also faces 2 civil suits for massive damages. Absurdly, he remains the frontrunner for the Republican nomination in next year's election. He could also be barred from taking office in terms of Section 14 of the Constitution for his part in the insurrection on January the 6th of 2020. These political uncertainties are, of course, not good for the share market. More negative news for the US economy came from the motor industry, where there's an ongoing strike. The United Allied Workers Union has got a strike going, which is affecting General Motors, Ford, and Chrysler. And apparently it's got to do with EVs, electric vehicles. They're unhappy about electric vehicles, which they say will cause further job losses. Of course, the one big EV company that's not affected is Tesla. And they're the biggest producer of electric vehicles in America. Elon Musk has resisted the unionization of Tesla, sometimes illegally, but the wisdom of his policy is now evident. Tesla shares have more than doubled since the beginning of this year. Anyway, our view is that the great bull market of the past 13 years is still ongoing, still continuing. There are some wild cards, however, which could impact on it, either positively or negatively. The first one, of course, is the war in Ukraine, which I will talk more about in a minute. Also, there are possible problems with the Chinese economy, where growth has slowed substantially, and there is the potential of a major collapse in the housing market. And the housing market in China is about 25% of the economy. The third wild card is the rising oil price. Just want to put that on the screen for you. Okay, here you can see the oil price on the screen now, and you can see there's the impact of the Ukraine war, Biden's visit to Saudi Arabia, and the downward trend in the oil price, which has now found support at around $72 a barrel on Brent North Sea oil. And then after that, there was an upside break, and that has continued in an upward trend here. Obviously, rising oil prices now approaching or have approached $100 a barrel again. This has been stimulated by perceptions of the US economy, which are generally positive. And it is important to understand that America uses about a quarter of the world's oil. So it means that a rising economy in America means a rising demand for oil. Obviously, if the oil price keeps on going up, it will ultimately slow economic growth worldwide because more and more disposable income, is diverted to transport costs. Okay, let's now talk about Ukraine. The war, obviously, as we have seen, impacts on the oil price. It also impacts on grain prices, obviously. But it has a much deeper, longer-term significance. It is a war between democracy and autocracy, literally between good and evil. It is the perennial battle that has been going on since the dawn of history. It dominates our religions, our legends, and our stories. It is also a battle being fought right here in South Africa, and it is very much the subject of the American 2024 elections. It has been well said that all that is necessary for the triumph of evil is that good men do nothing. Russia has become a pathetic residue of the Soviet Union after the fall of the Berlin Wall. Putin is the quintessential autocrat seeking to re-establish the USSR, trying to annex those satellite states that broke away in 1989. Those include Latvia, Lithuania, Poland, Moldova, and of course, Ukraine. The people of Ukraine are fighting on behalf of the free world. NATO is providing them with the weapons and support, and so far the US has spent about $100 billion in aid, including the package which is still making its way through the Senate at the moment and has not yet been fully approved. This should be compared to the US GDP of $23.3 trillion. In other words, it's less than 0.5% of their annual GDP, which in our view is a very cheap price for destroying half of the Russian army. And NATO has not yet suffered a single casualty in this war. Instead, it has two powerful new members, Sweden and Finland. Russian GDP is about $2.1 trillion per annum, roughly the same size as Texas, and only 60% of the size of California. Russia cannot hope to outlast the combined power of Europe and the US in economic terms. Putin's only hope was to win the war quickly before NATO became involved. He did that in Crimea in 2014 and thought he could do it again in Ukraine. Some recent evidence that NATO may be tiring of its support of Ukraine. You can find that in the Polish government's temporary stopping of aid to Ukraine because of the grain crisis, because of issues there surrounding their election and the grain crisis. That has now been resolved. There's also some opposition within the Republican Party, which is voiced occasionally. But in our view, NATO support for Ukraine will continue unabated. The Ukrainians are fighting a war which is unique in history, and they are making incremental gains, especially in the south and east. So far, they have taken back about 54% of the land which Russia annexed, and they're now close to breaking through the Russian defense lines and getting fire control over the rail and road supply routes to Crimea. Putin is hoping, obviously, for a lengthy winter stalemate to regroup, but I don't think he'll get that. I think that the Ukrainians have got their tails up and they're going to push through to try and get as much advantage as they can. He's also hoping that NATO will lose the will to continue their support for Ukraine, but we believe that that is not going to happen. Russia's position is now completely untenable, both economically and militarily. The ruble is barely holding on to 1 US cent, and it will probably fall further. Russia does not have the economic strength to continue this war, and the Ukrainians are benefiting from the precision Western weapons which they are receiving. They are also now the world leaders in precision drone technology, which has proved to be vital in this war. This contrasts with Russia's indiscriminate and ineffective barrages of firepower. Russia's Black Sea Fleet has been forced to leave Sevastopol. Russia's control over Crimea is now hanging by a thread. If Crimea is lost, then Putin is probably also lost. For how can he justify the enormous cost, both in financial terms and also in lives, to the Russian people? In our view, he will not be there for much longer. All right, let's turn our attention now to the political situation in South Africa. Of course, as the year draws to a close, attention is being focused more and more on next year's elections here in South Africa. It's clear that the ANC has lost considerable support because of load shedding, and that situation is not going to be resolved before the election, and in fact it may get worse. According to the National Energy Crisis Committee, there's no improvement really expected before the end of next year. That's bad news for the ANC. Load shedding hurts its traditional support base very directly. We believe that the ANC may end up with less than 40% in Parliament, and this will force it obviously to compromise with other parties. It is doing all it can to implement popular strategies to win support for that election. An example of that is the civil service wage hike of 7%, something which South Africa really cannot afford. But now the Treasury is struggling to balance the budget. Commodity prices have fallen, and with them tax revenues. The budget on the 1st of November this year will definitely see a higher deficit, and in fact VAT may be increased by as much as 2%. Another terrifying prospect for the ANC is that the Post Office Bank apparently comes close on occasions to failing to pay the social grants which are under its control. It's responsible for paying about 6 million social grants every month. Board members who have resigned from the Post Office Bank say it has on several occasions come close to not paying. You can imagine the impact of not paying those social grants and what that will do in the elections. Looking at the economy, the Monetary Policy Committee kept repo rate unchanged at 8.25%. This is roughly in line with what is happening in the US and also in the UK. The repo rate is about 3.5% below the prime overdraft rate. So if you take the repo rate and you add 3.5%, you get to the prime overdraft rate. That 3.5% is called the mismatch factor, and it's obviously how banks make money out of lending money at a higher interest rate than they're paying the Reserve Bank. The Reserve Bank has increased its 2023 forecast for GDP growth from 0.3% to 0.7%. Inflation is expected to average about 5.9% this year, with core inflation at about 4.9%. The interest rate decision was close, however, with 3 people in favor, 3 people on the MPC in favor, and 2 wanting a 25 basis point increase. But of course, the level of interest rates remains well above inflation, making an attractive real return for overseas investors. The leading indicator was up slightly, seems to be recovering, which is an amazing testament to the resilience of the SA economy and businesses in this country. But that level of growth that we are getting, 0.7%, is insufficient, obviously, to accommodate the school leavers, and that results in higher unemployment. The Bank Serve Transaction Index, also known as the BETI, fell in August to 134 from July's 135.6. That was caused by the taxi strike in Cape Town, Transnet's rail problems, and also obviously load shedding. Load shedding has a big impact on food producers. Libstar reported profits down 40% in the 6 months to June 2023. Shoprite also spent 1.3 billion rand on diesel just to keep its generators going. Pick n Pay has reported a loss for the 6 months to the 31st of August the other day, and that's resulted in them changing their CEO and bringing Summers back into the hill, which is quite interesting. The South African electricity grid gets about 6.2 gigabytes of power from renewables now, and about 40 gigs from coal. The coal-fired power stations have been much less reliable than the renewables power systems, because obviously they're older and they're subject to breakdowns. BankServe has produced its take-home pay, and they say the take-home pay came in at 15,578 Rand per month on average in August, and that's up 5.8% from July. It's the second monthly improvement in a row. The consumer price index was 4.8%, so the average household was definitely much better off in August and July. The construction industry is saying that there's less competition for tenders and more work available, so that's also a positive. Manufacturing was better in the third quarter. Businesses are clearly getting away from Eskom and finding other solutions. But overall, if you look at manufacturing in the long term, it has dropped from being 23% of GDP to just 13%. So it was 23% in 1980, and now it's 13%. But expectations for 2024 and for the economy have improved, showing a bit more confidence. The PPI rose by 4.3%. That's the Producer Price Index. It's the price index which measures prices at the factory gate. That rose by 4.3% in August, more than what the economists were expecting. They were expecting 3.7%. It's the first increase in a year, and probably reflects the higher cost of electricity, also load shedding, and higher food and fuel prices. Electricity has risen by 18.7%, and that's a massive cost increase. That's one of the reasons why businesses and consumers are moving away from Eskom. Mining production was down 3.6% in the year to end July. That's obviously due to load shedding partly, and also due to the fall in commodity prices. Platinum group metals were down 10.4%, coal was down 7%, and manganese was down 11.5%. SARS, South African Revenue Service, has warned that tax collections are well down, well below the February budget figures. In the first 5 months of this year, tax collections are 22 billion rand below what was budgeted. Mostly this has come from lower company taxes. Company profits are down, obviously because mining companies are making smaller profits, but also because higher interest rates and load shedding means lower profits generally throughout the economy. Lower collections obviously mean a higher deficit in due course. The Treasury recently increased borrowing on a weekly basis from 12 billion a week to 14 billion a week. That's in the bond market. The government is estimated to need to borrow about 600 billion to cover expenses this year. And that, of course, includes the 254 billion that it had to take over from Eskom. Demand for additional funding is pushing up the yields on our government bonds. This means that the government's interest bill is increasing. That interest bill is now at about 100 billion rand per quarter. Since 2008-9, the deficit has risen from 23.5% in 2008-9 to the current year, next year, which is 25-26, when it is expected to be 73.5%. The government is trying to cut costs, reducing the civil service by 200,000 people, freezing pay levels, obviously making the unions very upset, and they're also contemplating a 2% increase in VAT, which will impact the broader economy. These measures will not make the ANC popular in the next election. The midterm budget policy statement is due on the 1st of November, and will show how sharply tax revenue has fallen. It's down about 20% on last year. The government will have to learn to cut its coat according to its cloth. Of course, it's no surprise that Transnet on the 31st of March had a debt of 130 billion and was paying about 1 billion rand in interest every month. Transnet is now considering selling assets worth about 50 billion rand. It needs about 85 billion to pay for new infrastructure, especially in Transnet Rail. The Treasury is not interested in bailing them out further, so they're having to sell assets. The terrible rail logistics in this economy are now costing various businesses heavily. Road transport is about 4 times as expensive as rail. So this is another situation where the ANC took over a fully functioning system in 1994 when they took power, and have since then destroyed it through incompetence and corruption. The El Niño weather pattern is now officially in progress. It will likely result in a protracted drought in South Africa, beginning in 2023 at this rainy season which we're just going into now, and then developing in 2024. It will probably go on for several years and will cause us to have a much lower maize crop, which will result in us having to import maize to feed our population. Gauteng may well face serious water restrictions, and businesses and consumers will have to adjust to that. Record ocean temperatures means that this El Nino is likely to be worse than previous El Ninos. All right, let's have a look at the rand quickly. Just pick it up here. Let's get the chart on the screen. Right. You can see that the weakest level that the rand reached was over here in May, on the 31st of May, when it went to 1976.85, as high as that. And that was just below 20 Rand to the US dollar. Since then, it has strengthened somewhat, and it found some good support around 19 Rand 20. But as you can see, yesterday it broke up through that support. So it weakened through that support, and it's now at about 19.30 to the US dollar. Of course, the rand's weakness means that there has been a shift towards risk on in international markets, and that has caused people to want to sell, or international investors to want to sell their emerging market assets. Emerging market assets are always sold when there's risk on, and they're always bought when there's risk off because of the higher returns that they offer. The rand's value is very much a function of these shifts in international sentiment, but that must also be combined with the local impact of political risk and the effect of load shedding on our economy. The rand is always going to be quite volatile, but the trend is universally downwards. The rand is going to continue weakening. Rising local government debt levels are persistently a negative. Rand weakness has a direct impact on most JSE companies because most companies have an interest overseas, so they are exporting products overseas or importing products from overseas, and so the rand's strength or weakness has a direct impact on them. Many companies are rand hedges because they sell products overseas, obviously, and a good example of that is the mining companies. HSBC has forecast that the rand will fall to about 25.50 to the US dollar next year. And they base this on worsening government finances and the larger government deficit. A major factor will be the ANC's performance in the 2024 elections. The shape of political power after those elections may well be considerably different from what it is now. And that uncertainty is obviously not good for the rand, or markets generally, in fact. Okay, let's have a look at some companies. I'm going to begin with a property company called Attack. Attack is a property developer with about 52 buildings. It also has 5 managed precincts, what it calls managed precincts. The most important of these is Waterfall City, which is an enormous mixed-use development. The government employees pension fund is investing 2.7 billion rand in Waterfall City. When we look at the tax financials for the year to the 30th of June 2023, that shows disposable income was up 14.5%. They paid out 80% of that as a dividend. Their loan to value is about 37.3%, which is reasonable. Anything below 40% is reasonable. But what is interesting about Attack is that the share price is less than half of the net asset value, which means that the share is really good value. Since COVID, the share price, as you can see from the chart on the screen, is going up very steadily. So we believe this is a good share that will continue to perform well. The second share I want to look at is Barlow World. This is a supplier of heavy earth-moving equipment in South Africa and also in Eurasia. Let's put a bit more data on the screen here. It also has a business manufacturing starch through its subsidiary Ingrain. 2 major negatives have impacted on this price in the last few years. The first one was COVID, of course, and you can see that here on your chart. The second one recovered from COVID after this island, this support island here, and recovered quite well. And then it was hit with the Ukraine war, but now it seems to be finding some support at around 81.50 cents. In the 11 months to the 31st of August this year, 2023, revenue was up 15%, and earnings before interest, taxation, depreciation, and amortization, or EBITDA, was up 13%. Operating profit was up 46%, despite the fact that revenue from Russia was down heavily. The share looks cheap to us on a PE of about 5.8. Okay, now I want to look at a small IT company called Foresight. You may not even be aware of the existence of this company. What is this company involved in? Well, it's involved in the IT industry. It describes its business as digital transformation for businesses with the convergence of operational technologies and information technology with the business environment to ultimately reach artificial intelligence. Obviously, it's a cutting-edge computer technology company, which appears to be very successful. In its results for the 6 months to the 30th of June 2023, revenue was up 37%. Headline earnings per share almost tripled to 3.8 cents per share, but it's still not paying any dividends yet, preferring to plow back the profits into growth. As you can see on the chart here, it's been in an extended sideways pattern since October 2022 for about a year, and then it's broken now to the upside. Here you can see. And then we added it to the winning shares list on the 5th of August over here. The price on that day was 31 cents. It's now at 43 cents, which means it's gone up by 38.7% in, what is that, 2 months, in about 2 months. Okay, now this next share I want to look at is Calgro. Calgro is a property company which focuses on residential and memorial parks, residential developments and memorial parks. Let's close that out. Right, it's maybe 1 year is fine. Okay, here you can see how Calgro has been going up. This is a bit blurred, but we added it to the winning shares list over here on the 15th of August. At that time, it was trading on a price of 356 cents. It's since gone up to last night's close of 455. In its results for the year to the 28th of February, headline earnings per share was up 45%. And it recently produced a very positive trading statement, and it's trading at about half of its net asset value again, 50% of net asset value. It's also engaged in a very aggressive share buyback program, in terms of which it's bought back 13 million of its own shares in the market, an average of 233.8 cents per share. And since the share closed last night at 455, you can see that the buyback has been enormously profitable for the remaining shareholders. Since we put it on the winning shares list, it's gone up 27.8% in about 7 weeks. Okay, the next share I want to look at is Outsurance. Outsurance is a well-known South African insurer. It was basically what's left of Rand Merchant Investment Holdings. In the year to the 30th of June 2023, revenue is up 43.4%. The strong upward trend. We added it to the winning shares list, as you can see there, on the 14th of July 2023 at 36.84 cents. It closed yesterday at 41.08, which is a gain of 11.5%. Finally, I want to just talk about Capitec. You probably saw that Capitec brought out excellent results yesterday for the 6 months to the 31st of August. It now has 21 million active clients. Put a bit more data on the screen here. And it added 1 million new clients in the last 6 months. Headline earnings per share were up 9% in a very, very difficult economic environment. You can see here on the chart that it's breaking up through its 65-day exponentially smooth moving average and now through its 200-day moving average over here. It looks like a new upward trend may be beginning. In our view, Capitec should be a part of every private investor's portfolio. Okay, folks, that's about all I have for you today. I hope that you found something of value in that talk, and I will be talking again on the first Wednesday of November, so make a note of that in your diary, and thank you for listening to me.